Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
Moving to equity markets now, clearly momentum has been the order of the day. We've spoken a lot about new equity market heights being reached, and this has been the case again with the S&P and NASDAQ reaching new heights over the course of the week. When it comes to momentum, it is clear that this goes hand in hand with the AI trade. Momentum as a factor has had its best run on record, and we can really see this in evidence when we look at the semiconductor stocks, in particular something like Micron, which has seen a staggering increase in its market cap and its share price performance over the course of the week we've had here. So the course of the month has been pronounced, but the week has been very pronounced when it comes to Micron and other semiconductors. We've mentioned before that 1 trillion is the new black. So I think this chart is very telling just in terms of where we are and where we stand with some of the market caps in issue. What would be even more interesting would be to overlay this chart with the country market caps of, say, the UK, Taiwan, Singapore, all of which will be significantly smaller than any one of these mega market cap companies. But we can see here that in pink, this was the discussion around the two new joiners of the 1 trillion club, Micron and SK Hynix. We've also seen throughout Asia, TSMC be a factor, as well as Samsung Electronics. They now are the two other members of the $1 trillion club. Just to name a few others, Nvidia topping the table of 5.2 trillion, Alphabet 4.7, Apple 4.5, Microsoft 3 trillion, and Amazon close behind at 2.85. Then to compare, Meta is down the table at 1.5, Tesla 1.6, but still staggering returns. And interestingly, in terms of the time to which they have got to these very impressive market caps has been much more short. It took a long time to get to the first, say, 500 million in market cap, but to get from 500 million to 1 billion has been a lot shorter. And then for these to accelerate to 1 trillion has been significant. The importance of this move to the market cap is because, again, getting back to the concentration point, if markets are increasingly more concentrated, if one single stock can now dwarf whole country stock markets, what does that mean for the volatility that we are likely to expect in an equity portfolio? And how should an equity portfolio be constructed in order to give broad-based exposure? Clearly, with these large market caps and the concentration in, say, semiconductor companies or the infrastructure components of AI, there is tremendous concentration. Whereas there may be a diversification by client, it cannot be said that some of these companies are actually conglomerates and have multiple strands of business units. So tremendous amount of concentration mounting, and the excitement in Asia, where we've seen the Korean stock market up over 100% at one point year to date, very much driven by these tech companies, very much something that we are watching in terms of the composition of emerging markets. And we'll talk about that later. Another interesting point around equity markets has been the demise of the dividend. And whereas dividends used to be seen as a core yield substitute essentially in equity markets, and certainly a reason to invest in equities for certain investors who needed an income, the dividend yield of the S&P has been steadily declining. It's now hovering just over between 1 and 1.25% as average. Clearly, the idea of investing in equities as an income substitute has diminished significantly. Some of this will have been distorted by the fact that the large tech stocks are generally not issuing dividends, with some exceptions, but the equities as an income source has been diminishing quite significantly. And this then translates into the equity risk premium. When we compare the S&P equity risk premium to that of bonds, we can see it has been diminishing significantly. Some of that is because the bond risk premium has been increasing as those bonds have sold off, particularly at the more high duration end of the spectrum. But the equity risk premium shrinking in this way suggests that investors are not being paid for the equity risk that they are taking. And even though we have discussed valuations at length in this podcast before, it is worth reflecting on where we are relative to history in terms of whether investors are being paid to take risk. Clearly, that has not been the case for some time, as the equity risk premium has been declining over the course of the last 5 years. The other reason for holding equities, of course, is this singular exposure to a growth story, and in particular, this tech story. It has been hard to find that exposure to growth elsewhere in the portfolio.